Are you or your clients looking for a regular income solution with compelling returns to diversify your portfolio? If so, Neighborhood Holdings may be a great option for you. Listeners of this podcast will appreciate that public markets can be turbulent and finding a good private credit fund can be tough. But Neighborhood's track record, transparency, and investor alignment sets it apart from the pack. With nearly 10 years of consistent performance and a target net yield of 8 to 10%, Neighborhood has a track record of providing monthly income to investors without the volatility of public markets. How do they do this? Where banks invest in mortgages up to 95% loan to value, they also make borrowers jump through a lot of hoops. Many borrowers in transition aren't able to meet those hoops. Neighborhood has partnered with banks and brokers to provide quality borrowers with temporary financing secured by first mortgages at an average loan to value of less than 60%. Where other mortgage funds might take more risk by lending against construction, bare land, or jumbo loans, Neighborhood is focused on your average residential borrower who owns the average house in the neighborhood. Plus, their variable rate with a floor mortgage pricing benefits investors when interest rates go up and mitigates downside risk. Check out the link in the description or visit neighborhoodholdings.com to view the offering memorandum or speak to your financial advisor for more information. That's neighborhoodholdings.com/Loonie Hour. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin. Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 189. As always, joined by the three amigos. We've got the Boomer in the Ecodome, Rich Diaz, Montreal. What's going on? Boomer, where are you?
Boomer is celebrating a very anniversary with Mrs. Icecap. It's a big number, and we're down to the South Shore, Nova Scotia. So we're down here for a few days, hanging out in the water, having some seafood and stuff like that. It's a real nice place to visit. If anyone comes to the province, down to the South Shore of Halifax. And so we have this place rent. It was really cool. I call this a biodome because I saw it in the movie once, but I don't think it's anything to do with a biodome. Like this big, it's like an igloo, but it's, plastic. But it shields you
perfect for COVID, the next pandemic. You're all set.
Yeah, you can hang out in here. Get boosted, everyone. It's important. But it's a cool place here. You can hang out here. It's a bit chilly here right now, but it's a great place, especially for the acoustics. If you forget your mic.
Yeah, you have anything to say to the audience?
We have a Loonie Hour jar. What do we call it?
Loonie Hour fine jar, $100. This guy forgot his mic.
I think we should do corporal punishment or
what?
Corporal punishment when you get beaten. Never mind.
Loonie Hour meetup, there'll be a paddle.
By the way, Rich is looking for a date, so you're not going to get a date with that kind of stuff. It's
you never know,
yeah. Tomahawk on me, everyone. Not everyone. Sorry, Loonie Hour.
Everyone. There you go.
yeah. Like 5 million on Tomahawks. The next Loonie Hour get together. Rich, what's going on in your area where you are?
Oh, nothing. The weather's been absolutely crap. I think I caught a cold. I went up north. Oh man, the forest. Canada has a lot of trees, is my observation from the weekend. No, I just spent a couple days up north. It was amazing, chopping wood, using my chainsaw, mucking about.
They're off the grid.
It was awesome. Oh, and I had no reception, which was actually quite lovely.
This guy's too cheap to. He's boycotting Starlink.
No, it's coming.
Elbows up.
Starlink. Although it did cross my mind that maybe it would sort of take the charm out of going away into the woods for a couple of days and disconnecting from the markets, because when I logged back on Monday afternoon, I was like, holy crap, the Japanese 30-year, and we're going to talk about that, but it was nice to sort of miss that for a little bit.
Yeah, lots to jump through today. So we got the
whoa, Steve, what's new in Kitsilano, man?
Oh,
share that
with
cares,
the world, man. Nobody cares. Nothing going on over here. I'm just dealing with clients every day. Everyone's all upset and wondering why their house hasn't sold. So it's a tough life over here right now.
There's not enough signs to hammer down onto the front lawn.
I just tell them, I said, don't worry, it's just a gully.
Yeah.
It's yeah, no, it's bad. It's not great over here, but we're plugging away. We're keeping busy, and I always look forward to the pod. It's like my little escape. I need one
It's
of
like
those bubbles.
All right, what's
Some
going
people,
on?
my friends say I live in a bubble sometimes, and maybe
Yeah,
this is true.
commie bubble. Anyway, okay,
Okay,
let's
line
go.
us up. Line us up.
Canada CPI, we had that out this week. We have a little bit of Canadian housing sort of data. Rich put out some good charts on that. We want to sort of touch on that. We have some interesting updates from the Canada pension plan, which really concerns, I guess, all of our listeners who are almost certainly invested into that. We've got some a crisis brewing in the bond market, particularly in Japan and in the U.S., of course, which was probably going to leak through into what's happening here in Canada as well. We've got some issues brewing in the land down under, and so yeah, there's just a lot going on. We'll kind of take it around the world, but Rich, I think first and foremost, we had Canada's CPI inflation data coming out. I think was the BOC meeting next month, right? In June.
I think we have to make a bet soon. No, 2 weeks from the bet.
Yeah, yeah, we're a couple weeks out. Anyways,
Oh, okay.
so obviously the BOC is keeping a close eye on
But guys,
inflation.
that's gonna be a live meeting.
Oh
It's
yeah.
not going to be one of these slam dunks. So
No, it's
it's,
not.
yeah, it's exciting in the Loonie Hour world. It is
Can you
exciting.
just for the audience for the live meeting, can you just explain that?
Yeah. So normally when a central bank has their meeting, everyone knows beforehand what the result of the meeting is going to be. Like whether, hey, there's no change coming, or everyone knows that they're going to cut rates or hike rates. And that's, it's not a fun time really. It's okay. It's a boring meeting really. A live meeting, when they start the meeting, you have no idea what the outcome is going to be. It could be, I think in this case, it's either going to be no cut or a cut. They're not hiking, that's for sure. So that's a live meeting, and in the world of like nerds and all that's fun, cool things, podcasts, that's exciting to talk about, and put some carbs down on.
Yeah, well, I think right now, Keith, the market odds post Canada's CPI release, they believe market odds of a rate cut in June dropped from about 60% odds of a cut to now closer to about 30%. So markets, Rich, did not like the Canada CPI print. I don't know if you want to walk us through
Yeah, let's
the
do it.
details of that.
Okay, ready? Here we go. So
Drum roll.
Canadian headline inflation rose 1.7%. This was higher than expected, but only a little bit. 1.6 was expected in April. Overall, the headline inflation fell. So it was down from 2.3% in March. Remember, we're still working through, March was working through some of that GST holiday gimmick stuff. But April, the slowdown, and I quote, the slowdown in April was driven by lower energy prices. And what we can see, and that's basically the main takeaway. If you go to the actual release, which I do every month obsessively, and you could see basically there's a whole section on how the carbon tax was the main driver. And I can read it. The price decrease in April was mainly driven by the removal of the consumer carbon tax. Now, this is interesting for a couple of reasons. One, because we were told by our dear leaders that the carbon tax was not inflationary. And again, I think that is another one of those stupid lies to get policy through. And obviously, if you raise taxes on something, it can, or cut taxes, it can obviously change the price of that item, ergo prices in CPI or changes in CPI. So that was like the first thing. The second thing was really important, and the Stats Canada did the work for me, which is if you exclude energy prices, core inflation rose. So they do different types of carve-outs, as you know, core X food, core X mortgage prices, core X this, core X that, basically. And you can slice and dice the CPI basket into many, many different ways. One of the things that's really important is to look at these core measures to understand the underlying change in consumer prices. And that was one of the big points that the Stats Canada made, which was that excluding energy, core prices started to rise. And that's something we've been talking about a lot. And then the last thing, I'll switch over to you guys, which is just that, again, based on these carve-outs, we look at things like the three preferred measures of core inflation, which the BOC ignores when it needs to and emphasizes when it needs to. And I'm guessing that they're going to ignore it in a couple of weeks. But nevertheless, the core inflation is and one is based on a weighted mean approach. The other one is trimmed mean, where you sort of take out the extremes. And the other one is based on a factor model, which I always forget what it means. But the real takeaway is that they rose more than expected, and they are now above the target inflation control range of 2% plus or minus 1%. So there are two of them are above 3. And the trend really is that we're going to get higher inflation going forward, which which is what we're going to discuss, and how that's going to affect the BOC. Who knows?
And the gist of that is it's the highest increase was through food prices, right? I think it's
Oh,
it's what, 2 or 3 months in a row.
Yeah, so that's something we've also flagged. So one of the I have a couple of inflation, so ICE cap inflation models. You should always take models with a grain of salt. You can, if you know enough statistics, you can make a model do whatever you want. And it's really the higher producer prices. So those inputs into many of the costs for our consumer goods and services, etc. And one of those is food prices. So food continues to rise, and it was the highest. It wasn't the highest month on month, but it is now the highest year on year. So food prices are increasing 3.8% year on year, and this is because of those producer prices and a lower currency, in my view.
Boomer?
Yeah, I mean, so what's interesting, of course, we won't go heavy into it, but we were told the carbon taxes had no impact on inflation, and it turns out it actually did have an impact on inflation. So when we have the new form of the carbon tax coming in, which will be more affecting, in my mind, it's the PPI world, so producer price index world. Is that right, Rich?
Yep.
Steve, that's what you guys see as well. Yeah, so the snake, it will feed through, to consumers at the end of the day. So from a central banker perspective, you're thinking, okay, yeah, inflation is sticky here because carbon taxes are going to be coming back on in a different form. They also know that government fiscal spending is going to increase as well. And that's simply a function of Ottawa not telling us what they're going to spend. And usually that means they will spend more. And Ottawa, as well as the Bank of Canada, they all have the view that there's no recession coming. So they don't see growth as a risk in Canada. So it seems like I'm talking myself into the Bank of Canada won't be cutting at the next meeting. They'll be
Wait a second.
flat.
Can we unpack that for a second? So you think that?
Yeah.
I mean, what they say and what they do or think is surely different. See, I'm learning. I'm learning to be more cynical. I'm learning to be more cynical. So you're thinking that they're not worried about growth at the Bank of Canada? Surely they are.
I mean, they have to worry about something. That's what they're getting paid for, of course. My point is that I don't, I'm not inside there, but I get the impression they're always more worried about inflation. That's their job. Let's fight inflation. Price busters. Is it the Walmart commercials? The dudes going around busting the signs and prices are coming down. Yeah, that's what TIFF is trying to do. And but because inflation looks like it's going to stay sticky, and that's our view as well, by the way. And you share that, Rich, with the model. And they, in their mind, they won't be cutting to support growth. They just will be staying where they are because they're concerned inflation is a concern. Does that make sense? Did I say that the right way?
Yeah.
Well, Keith, I mean, to that point, when you talk about sort of the growth outlook, you look at the labor market data. Last month we added just a meager 7,000 jobs in April. And most of that was because you added 37,000 public admin jobs, which is actually just related to the election. So the labor market's contracting. You've got TD Economics out this week with the big, news article headline making its rounds all over social media, saying that Canada's on the verge of a 2-quarter recession with a potential 100,000 job losses expected by Q3. That's according to the TD's chief economist. And so, I don't know, everything sort of I keep reading online and just hearing anecdotally is just how soft the labor market is, particularly for the younger people looking for summer jobs now, right? As their school wraps up here, everyone's, looking for summer jobs, and just hearing that, the issues they're having there with youth unemployment. I know, Rich, we've talked about it on the show previously, which is that they're obviously competing with a plethora of recently landed immigrants. But I don't think the labor market's in a very good spot. So if you're the Bank of Canada, how are you kind of weighing those two factors to say, okay, core inflation started to tick up, the bond market's in disarray here, which we're going to get into. But clearly the labor market's impaired, and if people don't have jobs, they don't have any money to spend. So that's
Yeah, and I see, because remember, it's important to know how the Bank of Canada is going to react or what they're going to do, instead of believing or thinking, hey, this is what we should do, this is what we see, therefore they should do the same thing. So our view, Steve, is exactly what you just said. The economy is going to weaken. You said the jobs data, and actually it's kind of ironic. So TD came out with a report about suspected job losses and stuff. And what is the irony with that, Steve?
well, the
today?
irony is they actually cut 2,000 jobs, or sorry, they're cutting 2% of their workforce.
Wow, that's a lot.
So it's about 2,000 jobs apparently.
Oh, okay.
But I mean, so there you go. So clearly the TD economist must have had the maybe the pink slip put on her desk. But
They got the nod. You're
Yeah.
walking around the trading floor, and someone looks at you, and you get the nod. It's happening. But again, like that's where we suspect we're going to go. And here in the podcast, all three of us, we're receiving anecdotal evidence that the economy is getting weaker and softer. It's just that when I hear the Bank of Canada and read the Bank of Canada and all that, they're never in a view as a crisis mode. It's always inflation. So I do suspect that will change, but we're focused on June right now. That's my thought.
But isn't just like more broadly, and maybe this is a boring answer, but I think it's important just to remind the viewer that in the US, unlike in Canada, the Federal Reserve has a dual mandate. So it's inflation and full employment. If you can figure out what full employment means exactly, then I think you're going to get some kind of Nobel Prize. But in Canada, we don't have that, right? So the Bank of Canada just has an inflation mandate, ostensibly. Now, I think in practice, they're going to very much behave like they have a dual mandate, which is maybe front running my view for next week. But yeah, that's an important sort of technical piece that we have to remind people of.
I should add here, this is a good note from a good friend of the show, Bob Sacamano, saying that province of Ontario has now shed 107,000 full-time positions over the past 3 months. So outside of the early days of the COVID lockdowns, this is the largest percentage decline in employment since 2009. Of course, Ontario, home of Tiff Macklem himself. So, I mean, they're feeling the pain over there.
Did I hear that correctly? That the province of Ontario government, the provincial government.
Wait, did you mean private sector or public sector or everybody?
It's just to overall employment. So overall
okay.
employment,
Okay.
Ontario.
I was thinking
has
the same
shed
thing,
100
Keith. I was like, wow. The
Oh
provincial
no,
government.
Rich and I are thinking the same. Pause. Cut all this out.
Yeah, no, we're gonna.
But that is interesting, though, Steve. Ontario is the economic engine. For the real estate world. I'm sorry, for the economy. And if they're losing jobs overall, that's a weak.
Yeah, I mean, obviously,
nudge.
Obviously, I'm still looking at it from the housing perspective, which I think plays a huge role in the overall outlook for economic growth and jobs and everything. And I still think like the housing market is just in total disarray.
Well, let me just add. Can I just jump to finish up on the CPI, just because it's speaking of housing, which is something we've talked about at length, maybe ad nauseum, but which is the shelter component of core inflation, which is actually falling and had the lowest contribution to core in like 3 years. So at one point it was like 3% of all the core, so an incredible amount, much higher than the bank's target range. And now we're seeing that shelter component is falling off, and it's falling off because of all the components that make up shelter, which is owner occupied, so imputed rents for owners. Rents we know are lagging the street measures, but they're falling because of the population growth is slowing. And of course, your favorite, Steve, the mortgage interest component is also falling. So,
yeah. And then, like I said, your weakness in housing, and particularly in the new construction sector, which obviously employs so many people. where you're just not seeing any sort of expansion in that market. And then you look at, national house price data. We got that out. I think we chatted on it last week. We got, national house price data out showing, from peak to trough here as we are right now. I mean, national house prices are down 18%. I think that's about 29% on an inflation adjusted metric over the last number of years. And so, I think this is your sharpest correction since the 1980s. And I think there's more room to go based on the inventory levels that we're seeing really across the nation, but it's particularly concentrated in BC and Ontario.
Well, at least rates aren't going up. That's not going to hurt the mortgage world.
Yeah, we can definitely chat on that. I mean, that's a perfect segue, Keith. I know we've been talking about it in the group chat prior to this episode, obviously just watching the carnage that is unfolding, particularly in Japan. Keith, you flagged, how long we've been talking about Japan and the bond market there and some of the currency issues they've been having over the last, 12 months. It's kind of been on the radar. We've talked about it on a few episodes, but it seems like the issues are resurfacing. So I don't know if you want to kind of walk us through what you're seeing over there.
Yeah, it's simple, but it's also, complicated. It's simple in that it's our view that we absolutely going to have a crisis of some sort that's coming, but it's going to come from the bond market. The world hasn't seen that for a long time. Therefore, it's going to be completely chaotic and people won't know what to talk and write about. And then also when it starts in one country or region, it'll quickly get reflected in other areas. So, just this week, I think was it on the weekend or Friday or Monday, Moody's downgraded the US credit rating. You had that trigger point taking place.
Mm-hmm.
And, immediately, the internets were, oh, the US is going to go bankrupt. This is proof, you got to sell the US, get out of it, and all those other, perspectives and views, because of what they are. And you would have thought that if you're in that singular focused world, that the following trading day, the US dollar would have, fallen significantly. Treasury rates or yields would have increased significantly. And what's happened here 3, 4, 5 days later, once the dust settles, the dollar is a little bit weaker maybe against euro or something like that. But on yields, long-term yields everywhere have gone up, but they've gone up the most, I think, in Japan, to what you're leading with, Steve. And so again, people here in Canada are thinking, why are they talking about Japan right now? I mean, it's not the feng shui conversation, because we already established that was China last week, right, Rich?
Yeah.
Yeah, it still is. It still hasn't changed. But the problem or the challenge the world is going to have is that if China, if see what I did? If Japan runs into a liquidity crisis or a bond market crisis of any kind, it is absolutely going to swamp the world. And that's because I think, I'm pretty sure Japan is the second largest issuer of debt around the world.
The
the
highest
Americans
debt to
are one.
GDP. Yeah.
No, sorry, total issuance of debt.
Sorry.
And overall, the number one, debt to GDP, but the overall total, the Americans are number one, then you have Japan, and I think it's Italy is next, actually.
That's right.
But now with yields shooting higher in Japan, that has potential to create, what they call this yen carry trade to reverse. And what that meant was that people were borrowing in yen all over because the rates were so low, then investing that money, in the US, in the Bay Area technology world, or over in Luxembourg and the castles and things like that. All that could start to reverse. Then you have money flowing back into the yen, which would strengthen the yen. Bond yields could stabilize, the equity market will come down from that, but it's taken capital out of the rest of the world, so America as well as Europe and elsewhere. And it's going to have this huge shockwave taking place. So my point is that we could wake up any morning now and the world's going really funky. And is it because of the condo market in Toronto? Nope. It's because of what's happening in the interest rate world. Yeah, absolutely, you would. But I don't know if I shared that well enough. But again, like we always talk about, for Canada and Canadians, you should absolutely be aware of external events and shocks that could come back on shore and hit us. And I know a lot of guys following the Japan story for a long time. And every time it gets a bit exciting, they're finally ready. Hey, it's happening. And, it hasn't happened yet, but it sure looks a lot closer now this afternoon than it did a week ago.
Well, I guess markets are wondering when and if the BOJ is going to step back in and sort of calm things down, right? I mean, what does the BOJ own, Rich? I think they own over 50% of the bond market there.
Something ridiculous like that. But I think people, I mean, Keith, although his analysis was fine, I think he forgot to mention that we're at a 30-year high in that bond yield, which is like and it looks like a ski jump. I mean, it's amazing. And remember, like the longer duration. So when you think about bonds,
Rich, I think you should kind of walk that through just on like the longer end of the curve, the duration blowing out relative to obviously where the short-term rates are at.
So duration is like the weighted average of your payments over the length of the instrument that you own. All right. So just think about it that way, which is, I know, a bit complicated, but basically that's what it is. And so you have your coupon payments, which is your monthly interest rate or your semi-annual interest rate or whatever. And those are sort of brought forward and stacked up. And then your duration is sort of your weighted average of those coupon payments and your lump sum payment at the end of that bond structure. And the higher duration you have, the more sensitive you are to moves in the interest rate. And so when we see so when you have a 30-year bond, which is probably, I'm guessing, off the top of my head, probably has a duration of, let's say, 23 years or whatever, or maybe a little less, whatever. Anyways, and so you have a move in the bond yield of 75 basis points. You do 23 times 75. Oh, we're getting into a really big Loonie Hour, well beyond the scope of Loonie Hour math. But the point is, you're losing something like almost 15 or 13 or 25% over that amount of time, right? I mean, again, Loonie Hour math. But my point is these are significant moves that we haven't really seen in 30 years or so. We've seen jumps in the 30-year bond yield in the U.S. over COVID naturally, and coming out of it during Joe Biden's deficit spending regime. But then things calmed down. In Japan, it wasn't like that at all. Yields were very, very low for a very, very long time, and for the first time in a generation, basically, we're getting those yields ripping higher. And again, because the duration is so big, it means enormous losses on people's balance sheets. And so this is going to affect how banks are dealing with that loss, how insurance companies and other financial institutions.
Aren't the laws? Go ahead, Keith. I'll let you chime in here.
Yeah, so at the end of the day, the Bank of Japan are halfway through to their ultimate goal,
which is to go bankrupt.
No, to own all of the Japanese.
Okay.
Steve got this. Rich didn't. Steve didn't. Rich didn't get
but
this.
Keith,
one.
What option do they have realistically? Again, if all your financial institutions, which are mandated to carry and hold, government bonds, if your value is obviously impaired, right?
I mean, so you have to look at
I
it.
guess just rewrite the rules. I don't know.
Well, you have two perspectives here. One is that you cannot rock the boat. Like, I have a view, I have a way I can walk in and completely change things for the Canadian financial situation that we're in. And it would not be appreciated by the status quo. I know that, but I know it would completely work. So what is the probability of my strategy getting implemented? What is it, Rich?
Very low.
Yeah, it's literally zero, right? Because like no one has the courage to do what's needed. In Japan, as well as elsewhere, it's, hey, this is the policy, this is what we're going to do. And you literally do it for as long as your work term is running. And then when you leave, it's someone else's problem. You just try to keep it going, right? That's it. And we all know that, on a long enough timeline, your life goes to zero. That's what it is. But, a lot of these are getting a bit long in the tooth. And that's when people say, oh, come on, Loonie Hour, you've been worried about things for a long time. Yeah, but, remember, Rich was talking about long-term rates. And long-term rates in the early 80s in Canada, the US were almost 20%. And when they went all the way to zero down to 2009, it was basically 30 years of that happening. And when that happens, it's awesome. It's a great time to be alive. And then we flatlined rates for a decade. Now rates are finally going up. So when, people like us, the Loonie Hour guys are saying, hey, this is catching our attention. And when long-term rates finally start to go higher after 40 years, plus you just came off 15 years of everyone living on zero rates and low rates with no recessions, and you believe that's the way the world is always going to work. But that's my point when I say, hey, things have to change, but no one is going to have the courage to do it up front. So it's going to happen, and it's just going to shock the shite out of some people. And it's going to be amazing. We're going to have some pretty good episodes once it starts to go down. Is it Japan that is the trigger point? I don't know. I wouldn't have had Japan as number one. I think it could be China, could be number one, or the UK. But I never had that on my bingo ticket this week.
Ever been abroad and needed Wi-Fi? Download Saily. Tired of telecom oligopolies ripping you off? Download Saily. Want to avoid sketchy SIM sellers at the airport? Download Saily. Saily might be the only travel app you need. It provides an internet connection wherever you travel and saves you money on roaming fees. It's easy to use, affordable, and reliable all over the world. Saily is the modern, seamless way to get connected without the need for physical SIM cards. With eSIM technology, you can instantly activate service from anywhere in the world. No more waiting in line for a local SIM or dealing with expensive roaming charges. Saily offers flexible plans to fit your needs, whether you're traveling for work or leisure. Plus, you can switch between networks in just a few taps, ensuring you always get the best coverage at the best rates. Whether you're a frequent traveler, an expat, or just someone who wants more flexibility with their phone, Saily's got you covered. No hidden fees, no contracts, just affordable, reliable data wherever you go. Visit Saily.com/Loonie Hour for 15% off. Well, yeah. So I mean, you're seeing this obviously ripple across not just the Japanese markets, but the U.S. market. So the U.S. 30 years now just north of 5%. It's actually the highest since October 2023. Of course, I think remember those times we're having some sort of a tumultuous time there as well. And then basically we're 9 points off an 18-year high. So we're not far from an 18-year high.
So
in that
back
US
in
30 years.
2012 or 14, I forget the year. But long term, the 10-year in Italy went from 4 to 8 to 12 very, very quickly. And they got shut out of funding markets at the time. Spain was right next to them as well. If rates go higher and very quickly, it's going to create a adjustment. But as long as you can continue to fund your debt, you're okay. You're going to be able to do it. It's just more expensive, which means there's less tax revenue available, for required spending, what we need to do. So one thing, and I was thinking about this all week, what some people don't realize is, most debt in the world, whether it's treasuries or JGBs or, German bonds, you name it, people think that, they're going to start selling the debt and they're going to put it somewhere else. That's not the way it works. So if you are a pension fund or a big fund of some kind, and all of a sudden you have 200 million maturing or $1 billion. So by the way, so the way a fixed income desk works, if you're running a big fund, every day you run your maturity report, your cash flow report, money coming in, money going out, you got your net. For big pension funds, there's always money coming in. But when you have a bond that's maturing, they don't make a decision, where can we invest this now? Maybe we'll put it over here or there. What they do, they look at their duration for the portfolio and they see what they need to add to maintain that duration for their fund. So if all of a sudden, if one bond is maturing with the US Treasury, for example, they're absolutely issuing another one on the same day. That's the way the cash flows work. You're taking what was the example? 200 million, I guess, whatever it was. You're automatically rolling that into new issuance. So I'm just saying, don't get too caught up in the belief that people are going to start selling, their bonds and stuff. Maybe a retail guy might do it, but the really big money, when they hold a treasury bond or any other type of government bond, when it matures, they're always rolling it over into the equivalent again. There's not this magical stuff. All the magic happens in the equity world and in other places, not in the treasury market.
Well, Keith, that's what I wanted to just talk about, because I think there's another angle to this, which is, what rising rates ultimately means is tighter financial conditions. And people often, there's like a sort of a quip where people say, "Oh, the bond market's working, doing what the Federal Reserve can't do or should do or shouldn't do."
Doing what governments,
Right.
creating fiscal restraint on governments, because no one's willingly going to run, austerity. No one wins an election saying, "Hey, I'm going to cut all your social aid and all your social programs," right? I mean, it's the
Right.
bond market that flicks that.
That's exactly right. And for a long time, as we've talked about at length on the podcast, the bond market wasn't really doing its job because the central bankers were intervening, cough, cough, CVC, to keep the to keep the bond yield really low. And what's fascinating about what's happening now is that, the bond market is sort of quote unquote out of control, and that's going to raise it's going to make financial conditions tighter. It will literally make mortgages in the US tighter, right? Because those 30-year mortgages, not tighter, excuse me, more expensive. It's also going to change how people perceive equity, right? Because often when you're making asset allocation decisions, it's the decision: are you going long bonds or equity? There's some equity risk premium, which is sort of what you're supposed to be getting for that extra growth and the risk associated with that growth. And those are all kinds of decisions that are related. Basically, they're sort of fall back from that bond yield and that yield curve more generally. So it's going to be really interesting how the equity market plays. I don't think the equity market's going to be very happy about the US 30-year bond yield hitting a 25 or 30-year high. I can rest assured that'll be true.
Yeah, it's also just domestically here. Obviously, people that are paying attention to the Canadian housing market. It's funny, like the number one conversation I've had all year in the last 18 months plus is like every single homeowner, right? I mean, I would say there's a good chunk of our clients, people we talk with, that don't listen to the Loonie Hour, and they don't have any interest or knowledge of the bond market. And so, I would say the majority of Canadian homeowners are just picking up the Globe and Mail, or they're watching the CBC News headlines, and the thing that they read is, oh, interest rates are coming down. The Bank of Canada is going to cut rates this year. These three big bank economists say there's going to be 4 rate cuts this year. So every conversation I've had has been, well, why should we cut our price? We can just wait. The Bank of Canada is going to keep cutting rates. That's what we're reading. So like once the rate cuts happen, that will automatically mean like the housing market's going to bounce back. And I can tell you that's like the overwhelming conversation I've had. And obviously, you're not going to sit there and lecture them 30 minutes about the bond market and what's happening in Japan. But
you are not selling houses if you do that.
Yeah, exactly. So you just sometimes you have to say, oh, sure, okay, better, right? But like the reality is like we're not really seeing any movement in fixed rates, right? Yeah, sure, the Bank of Canada is cutting, variable rates are coming down, but the overwhelming majority of Canadian borrowers are fixed rate mortgages, right? They're 3-year mortgages, they're 5-year mortgages. So if you look this week, right, I mean, the Canada 5-year bond yield, which is prices your 5-year mortgages, I mean, it's 2.96 today. That's the highest reading since early January this year, right? So there hasn't actually been any real interest rate relief, hardly, for a lot of these borrowers. So if you're renewing a mortgage this summer, I mean, it's no longer 3.99 like it was 4 weeks ago. You're 4.2, 4.3.
Steve, yeah, and just to add, because this ties up in the beginning part of the conversation today, when we were talking about what the central bank might do, and you guys frozen?
No, we can see.
Oh, well, Steve was moving, but Rich was like leaning forward, like just so interested.
I'm paying attention to you. It's not supposed to.
Yeah,
you are. Thank respond.
You. Yeah, that's very kind. But the main data point that you shared at the beginning of the episode today, Steve, was about layoffs that are happening. Job cuts are taking place. TD had the announcement, of course. If we start to see more job losses, the commercial banks, they're going to raise mortgage rates on their own, regardless if the Bank of Canada makes any actions whatsoever. So it ties in, like, for example, like Rich, you were just saying, the bond market can make a lot of corrections for the market or for us, so to speak. The same thing happened in the mortgage market. So without the Bank of Canada doing anything, mortgage rates can absolutely creep higher, a lot higher. And that's if commercial banks start to see, if they believe that the probability of them having losses to write off, then they'll do that. So you'll have the 5-year, or I think with the 5-year you mentioned earlier, and you'll start going higher. We could be at, we're right now 3% on the 5-year.
No, yeah, you're 3% on your 5-year bond, basically. Essentially, we're there. So yeah,
So
mortgage
we could be at
rates.
4
Yeah.
by the summer. Yeah, it
I mean,
could happen.
the Canadian 10 years, it's funny, as we've talked a lot about this, but the global risk is synchronized. And if the risk is in the sovereign debt market, it's not clear the Canadian long-term bond yield will be able to avoid sort of getting sucked into that vortex. And I think that's sort of what's happening. You can see the 10-year bond yield is just moving with the US 10-year and the Japanese.
Correct. So if the US 10-year continues to go higher, it'll pull everyone else up with it.
Yeah.
Which is interesting, right? Because I think, Keith, the whole conversation, I mean, everything around sort of the Trump tariffs and sort of their strategy. I mean, Scott Bessent, Treasury Secretary, has basically said, listen, like, we're focused on the bond market. I mean, that's kind of what he said from day one. Obviously, that's when you saw yields falling quite a bit in the early days. And now I'm sure he can't be happy sitting there at his desk, watching what's happening unfold in the bond market because, I think he said, right, like, oh, Wall Street's had their day. And we're focused on sort of the working class now, and one of those ways is obviously to get rates down so people can afford to go out and buy homes. And your 30-year treasury, your 30-year mortgage in the US goes from 7.5 down to 5. But I mean, again, I'm kind of curious what this administration has up their sleeves, because I don't think it's playing out exactly how they had planned.
I mean, so I don't think any government can control what the yield curve is going to do and all that, because it is an open market. And like, whereas smaller or tighter markets, like in Canada, for example, or the European or Japan, policy can affect that to a degree, but the US market is so large. I mean, the bond market is going to do its thing. If anyone is really super interested in escalating risk and stuff like that, you have to watch the repo market. That's what to look for. And I saw a few repo headlines pop up on my screen earlier today, and then you say, okay, wow, this is now getting interesting. So I mean, we have no answer for anyone today. In 2 weeks we will, of course, but not today. As we
But Keith, I mean, Steve makes a really good point, which is, the US budget has contributed to the rise in the 30-year bond yield, right? I mean, it's a similar, I think it's not quite the same, but it rhymes like the Liz Truss budget of a couple of years ago, when Liz Truss presented a basically uncosted tax cut for the UK. You can make the case that the UK should cut tax rates, but that's sort of besides the point. And the bond market wasn't happy. And what we just saw last night or the night before, which was that the US Congress, so the lower house in America, passed a major spending bill. And it's not clear at all that the budget is costed, or that it will rein in budget deficits, as was sort of talked about during the election. It's not clear that it was a good idea. And then I think the bond market's taking a view on that, the US debt will continue to rise, as is forecasted by their own staff and their own data and own data releases. So I think that definitely plays a part. I think if the US ran much more sort of hawkish, or it was much more fiscally disciplined, I don't think the bond yield would be reacting in the same way.
Yeah, and that's the same everywhere. I mean, I am not taking the position to defend one country or government over another with their fiscal policy, because they all have the same policy.
Yeah. Spend.
Yeah, it's all spending more than they're collecting in taxes. And, to close that gap, they want to raise taxes. We got to talk about Australia, by the way.
Yeah.
And, for the Americans to improve their fiscal position, it's just not possible. I mean, it's just not going to happen because of the required spending with military and social security.
Keith, I'm very curious to sort of see how the Carney government plays this out, right? I mean, obviously, he was elected as this superstar central banker that obviously is well aware of fiscal deficit spending and the implications. And again, we don't have a budget that will be released until the fall. And we've already, even in his election platform, right, has promised massive deficit spending. Albeit he says, well, it's on
funded by funded. Sorry to interrupt you, but funded by the phantom tariffs. Anyway, sorry.
Funded by the tariffs, which were exempt.
What are the phantom tariffs? What does that mean?
Well, Steve will let us know the timeline.
Rich, you're following it closer than I have, but essentially it was elbows up during the election, but in sort of behind closed doors, they had effectively created a whole bunch of tariff relief where you could basically go and apply to the Canadian government. You would give them sort of a line code to say, hey, it's basically long story short is they actually had tariff exemptions the whole time. So was it Oxford Economics?
Oh, I can't remember.
I think it was Oxford Economics basically did the calculation saying that effectively there was no retaliatory tariffs, despite obviously the rhetoric out there that was saying, hey, let's slap them one for one and show them how tough we are, elbows up. But in fact, behind closed doors, they had actually already kind of worked out that they were going to not have retaliatory tariffs.
Keith's going to read us the definition of gaslighting again, but slower and louder and in French. No, I mean, they lied. That's what it was. It was a campaign strategy, which they used very effectively. We talked about this a bit, but one thing I want to add was the line item in the costed platform was left in there after they removed the retaliatory tariffs.
Yeah, so
right?
just
provide more detail. Yeah,
so there's a line item. There's a line item in the budget that basically their costed platform. There's a line item that says we're gonna, receive or earn X amount of billions of dollars from retaliatory tariffs or from tariffs from the United States. And of course, there really was no retaliatory tariff. So I mean, obviously it's politics. Like you said, we've kind of gone over this. It was brilliant politics at the time. We spooked the hell out of every Canadian to stick their elbows up in the air. And now I think he's actually come out in a press conference this week saying that we're actually going to get closer ties to the US. So Doomberg,
new strategy, knees down.
Yeah. Doomberg.
Never mind. Boomer didn't get it. Sorry, keep going.
So it's Doomberg has nailed it so far. Doomberg, if anyone hasn't listened to that interview, I think he's called it brilliantly. It's still one of my favorite interviews on the Loonie Hour, 189 episodes in, which is to say that we're going to get closer to the United States and Carney's the chosen one, and we'll see how the rest of it all plays out. But speaking of elbows down, knees down, is we had Canada pension plan. Did you read that one?
Yeah, but I mean, do you want to just tell us a little bit about the pension plan thing, and then I'll tell you I have a hot take on the pension plan thing.
Oh man, so Canada pension plan. Well, first of all, they just announced they're abandoning their net zero target. So they had a net zero target, and now they're abandoning that, which again, Rich, makes sense, right? I mean,
it was fake. It was bullshit from the beginning. Sorry.
Yeah,
sorry.
Well, I mean, all of us.
But you know what, guys? They have at least 50 people, maybe 100 people, working on that strategy.
Yeah,
for the pension fund. So those lads, maybe they lost their jobs? We see coming up, but it's a big deal. It's a big deal for them to finally come out and admit, yeah, Loonie Hour is right, and we're not going to follow this anymore.
Well, yeah, I mean, right. I mean, what's their fiduciary duty? It's to earn the highest return on a risk-adjusted basis for their contributors, people that take their hardworking dollars and have to contribute into Canada Pension Plan for their retirement savings. Your job is to earn the highest rate of return. It's not to push some political agenda of net zero. And so it's funny, they come out and they say, quote, forcing alignment with rigid milestones could lead to investment decisions that are misaligned with our investment strategy. To avoid that risk and to remain focused on delivering results, not managing legal uncertainty, we have made a considered decision to no longer maintain a net zero by 2050 commitment, pension plan said. So they manage $714 billion on behalf of Canadians
for their retirement plan. And it instituted a net zero goal starting in 2022, saying it would invest heavily in decarbonizing high emitting sectors and double its green holdings within 8 years.
I mean, this is, I think, good news for Canadians. I think it's also another chalk one up for another win for the Loonie Hour. I think we talked about how this started. I think it's all to do with interest rates and rising interest rates. I think in a world of free money, all these projects that are fanciful, that have infinite duration, that survive in a negative real rate environment where you can borrow with impunity and no one ever has to pay any money back in real terms. I think all these projects sort of get green light and have amazing forecasted returns. I think as soon as the world starts demanding a proper yield for their capital, I think it really focuses the mind and changes people's math. And by people, I mean the pension funds. But we also saw this from the shakeout from, this is also partly to do with the ESG mandates that we saw and the pushback from places like the state of Texas, which is an enormous pension plan. Texas is one of the largest states by population and by GDP in America and has a meaningful sort of economy. And when they started to push back on this, we talked about it and we said this was sort of the beginning of this trend. And I think what we're seeing from the CPP and the board that runs it as a continuation of this trend, which is, it was a fraud to begin with, marketing shtick that people sort of went along with. And we're seeing how inevitably there was going to be a pivot away from this when shit got real and
Rich,
when it's happening.
you missed the best part. So again, elbows up. The Canada Pension Plan, according to its annual report, which was released for March 31st, the total exposure to the United States market, again, as of March 31st, the total exposure to the United States market grew to 47% of its portfolio. So 47% of its portfolio is invested in the United States. That's up from 36% 2 years earlier.
So there's a couple of things that people need to understand. That's technically underweight global U.S. exposure, weirdly, right? If you think of the U.S., people think of, so if you think of the MSCI, which is your global country weight or sector weight, and you have U.S. is 60% or 62% or whatever, if the CPP is running at around 40, you could make the case that's actually quite underweight the U.S. relative to global equity exposure. Keith doesn't agree with that. Okay, well,
yeah, your math is off on it.
But anyways,
that's assuming a 100% equity.
Right. Oh yeah, sorry, excuse me, you're right.
Yeah,
you're
they're
right.
probably at 40 for equities.
I was just assuming that was the equity. That was the equity exposure. But no, Keith's
like that
right,
that would include infrastructure as well. Sorry, I didn't mean to be that guy. But infrastructure could be 15%.
Yeah, fair enough. No, that's a good
other
point.
stuff. Yeah.
That's a good point. The other thing I think
Steve's
is
main point is that it's increasing. The allocation is increasing.
Right.
Ironically, at this exact same time when people were told don't travel to the U.S. because they're going to detain you at the border. Don't buy U.S. goods and all that stuff.
But Keith, has it increased because the U.S. was like the best performing equity market over the last 2 years? Like that's also part of it.
I don't know that could contribute to it, Rich. It absolutely could. I got the impression though that the allocation was bigger. So either they were putting more of their contributions into the U.S. markets, or if the U.S. market got bigger, it meant another market got smaller. They took money away.
So remember, we talked about this on a previous podcast. I don't know, maybe 6-7 months ago, when former Finance Minister Chrystia Freeland was out saying that they were looking at discussing how to get the Canada pension plan to invest more domestically here in Canada. Or they're looking to sort of almost sort of force capital to stay in Canada. And of course, obviously seeing the allocation push higher into the United States over the last, which I have no issue with, right? Keith, you and I think are on the same page, which is, they should go where the highest and best return is. And if that's in the United States.
Well, but that's the thing though. So here's where I think I might change my mind, and not for the reasons You might think. So I think it's outrageous for a finance minister to tell pension funds where to invest their money. I think, as we've discussed, they should create a business environment that attracts money and not do everything in their power to scare it away. But if you look at the valuations and the flows, and again, interest rates and how they affect long duration assets and long duration sectors like tech, and how valuations in America relative to the rest of the world are wildly out of whack, and specifically Canada's performance relative to the United States, now might actually be a really good time to lower your exposure there. So it's just, I mean, I think it's more coincidence and irony rather than like a good, sound business decision. But I'll share the chart with you guys, and then you'll see maybe now is a good time to get out of the US.
That's a good soundbite, Steve. That's about it.
Speaking
It
of,
doesn't work. So what, like, for example, just to add to that, if you're running, big money like that, and you say, hey, we want to be in infrastructure. Pension funds love infrastructure because it's a long duration asset or investment. Like, it goes on for decades. Um, there's only so many opportunities for that in Canada. So by default, you have to go outside of Canada. So if the Canadian government mandated, hey, you need to allocate even more money to Canada, it's a tough place to find opportunities. Say like AI, what all the young kids like these days, whatever that is. How do you invest in just jokes, of course. How do you invest in AI? Where do you go for that? You got to go to the US most likely, to capture those opportunities.
Yeah.
Anyway, it's a tough decision, but I am happy to hear that they seem to be making allocations that is in the best interest of you and I, because it is our money that's in this plan. And everyone has an opportunity to start collecting at age 60 if you want to, or even wait a little bit longer. That was a good story. That's a good story this week.
yeah, and then Keith, you wanted to touch on what's happening down under over in Australia. They've got some new tax rollouts there.
Oh, mate, it was a good story this week. So what's interesting, around the world, all the Western countries, they all get together. They all have the same problem, and that you're not paying enough money in taxes, so they're trying to figure out how to get more of your money. Back in 2012, the IMF released a global wealth tax paper, which was I found that when it first came out, and I started pushing it around, and it attracted a lot of attention, saying what the heck was going on there. So that sort of went into the background, but now, and this happened in, I think, the Democrats floated this. Kamala Harris floated this idea during the election to tax unrealized gains. That's what the premise was, and which is a horrific idea, by the way. We'll talk about why and how that could affect Canada. But again, they're trying to find another way to get more tax money. So in Australia this week, they announced that they're going to, if you have more than 3 million in financial assets in the pension plan system, they're going to tax you on that, whether you took money out of the plan or not. So they're taxing unrealized gains, of course.
So
and
they would impose an additional 15% tax on earnings, including unrealized capital gains, for what they call superannuation, which I'm assuming is an equivalent to like an RRSP.
Yeah.
Balances above 3 million. So effective as of July 1st, 2025. Now the tax, from what I'm reading, is not yet officially passed. But the bill, I don't know, Rich, maybe the bill has passed the House of Representatives, but faces opposition in the Senate, where it requires support from the Greens and additional senators to become law.
It's a crazy idea.
Yeah, so let's talk about why it's crazy. But first of all, it is attractive to governments because it's, hey, rich people have investments with enormous unrealized gains in it because they've held it for decades, and they're just living off the dividends. And it is what it is. Nothing wrong with that. They did nothing wrong. But the government sees this as, wow, like, we're actually not going to get any of that money until the dude dies, and you get the probate and all that stuff taking place in the final tax return. So why don't we start tapping into those unrealized gains? So they came up with this $3 million threshold, and it's sold as, we're just taxing the rich. Don't you think the rich should pay their fair share? And of course, everyone says, yeah, everyone agrees with it. So, this is attracting a lot of interest. So let's just bring this to Canada, for example.
Oh, and just to add to that, so the Greens. So remember, it has to pass. The Greens have actually pushed to lower that threshold to 2 million. So not 3 million, but 2 million, which could then impact 1.8 million Australians. Again, if unindexed, because as of right now, right? I mean, it's unindexed is what they've proposed. So
So 2 mil, why not make it one, right? But that's a point. So two things here. Once they pass it, even if it stays at 3, they've already opened the barn door, right? They'll lower the amount in future tax years coming up.
mhm.
Let's look at Canada as an example, and everyone listening, you're going to know these people. There are, hundreds of thousands or millions of Canadians that have held Canadian bank stocks for decades, and the cost per share on their holding, it could be 90% lower than what the stock is now, or multiple times lower. They've made, 1, 5, 10 times the money. They've never sold it. So let's just say that family, say they're picking up 200 grand a year in dividends or something like that. All of a sudden, Revenue Canada says, hey, you are now, you haven't sold your bank stock, but we're going to tax you on that unrealized gain. And your tax bill is now for that, let's just say it's 100 grand, which is actually, it'll be a lot more than that, but let's just say that's what it is in the situation. Now this family, they have to come up with 100 grand to pay that, and they don't have it. The only way they can come up with that money is either sell their house or real estate, which if they haven't already, they're probably not going to, or they have to sell their investment portfolio. And what are they selling, Rich?
Bank stocks.
Stocks.
Yeah,
Bank stocks.
Steve got it, man. Absolutely. Yeah. Steve is number one Loonie Hour guy today. He's on the ball. He's sharp. He's sharp. He got his elbows up today. So all of a sudden, you could potentially see thousands of Canadians dumping bank shares to pay a tax bill on something they haven't even sold yet. So it's forcing them to sell, which triggers this cycle that's taking place. And it's or think of it another way. Think you don't hold any in stocks. Say you have this enormous unrealized gain in an investment property. Say you put $1 million into it, it's now worth 5 million. You're being taxed on 4, I'd say 30%. That's 1.2. That's good Loonie Hour math right there. Yeah, you need 1.2. You're a chump because you don't have 1.2 million in cash in your account, and you're literally forced to sell the farm. You have to sell it.
You're gonna sell the house and then the worst illiquid market we've seen in multiple decades.
Yeah, it's just a bizarre. And you go back to, it's not, again, it's always the wealthy is not paying their fair share. In my view on it, no, that's not the case at all. No matter how much tax money is collected, it is never enough. And it doesn't matter if it's the red shirts or blue shirts in power. They're not going to be able to balance their budget, as you guys suggested earlier. So, we literally do have to dramatically change how things are being managed and financed. I just don't think there's any hope with it at all.
But Keith, it's an interesting concept, right? When you overlay that and you say, wow, man, these guys must really be desperate for tax dollars. When we talk about obviously the issues that are surfacing in these sovereign debt markets, right? These government bond markets, which are yields are blowing out because people are worried about governments unable to rein in deficit spending. There's no way to finance this, so bondholders are asking for a higher rate of return, worried if they're ever actually going to get paid back, at least in inflation adjusted terms. And so now you start going down the spectrum and you say, okay, well, now you start getting these unrealized tax policies coming in. And I think it's just a symptom of where we're at today, which is, we've talked about financial repression on the show. And, I think either way, the governments are going to come for their pound of flesh.
Well, they can come, but they might not get it. I mean, the thing about Australia, unlike China, is that it has an open capital account, and people will simply move their money away. I mean, it's very straightforward, and it's the classic thing, the law of unintended consequences.
Rich, can I
Go ahead,
chime in
yeah.
there just one sec? I don't know exactly Australia's rule. I know, like, for Canada, for example, like if you're like locked into your RSP, and let's just say you got $2 million in there, it's not that simple to just like, oh, I'm pulling out my RSP money and heading to the United States and deploying it there. I mean,
Fine,
obviously,
but people just take their money out of the superannuation fund,
yeah. I'm
right?
just saying
They'll just cash in their chips before the date of the law, right? Because
yeah, but what's interesting with this, I'm surprised the date is July. I promise you, if they do this, they're going to make it retro to last year.
Okay.
You,
All right.
you can't tell them we're going to open the door so anyone can leave before it. You can't do that. I mean, there's like the increase in the capital gains tax in Canada last year. Like, what an F up that was. People are still trying to sort that out.
Yeah.
Remember, it went from 50 to 67%.
Yeah, I heard a story. I heard a story. Guys selling apartment buildings, selling
entire apartment. I know guys that rolled over their investment portfolios as well. But the other thing is, so let's just say the three of us, we're pretty successful podcasters. We've accumulated hundreds of millions, and we decide, you know what, we're going to open a podcast brainstorming facility, and Australia is a pretty cool place to do it. And we're about to pull the plug, and Steve says, "Oh, wait a second. Did you hear about this wealth tax that they're putting in Australia?" And Rich and I say, "No, tell us about it." Say, "Well, it's going to work this way." And we know this project is going to be incredibly successful. To which we're then going to say, why the hell are we going to put it in Australia? It becomes this gate on foreign capital coming and going. It will leave and it will not come back in. This is a horrible policy decision for the guys down under. And for my God, if anyone in Ottawa is listening today, and I know you are, do not put this policy in place in Canada. Like this would be one of the worst policy decisions to come out of our country.
There's another element of literally the feasibility of it. So as I'm reading now, you can see that these self-managed super funds, these superannuation funds, they can be invested in a wide range of assets, including non-publicly traded assets. So you're going to have to hire another fleet of bureaucrats who have no experience valuing anything at all. And they're going to be tasked with being effectively investment bankers and equity analysts of the highest order, because they're going to have to go into, not only going to have to do a good job valuing public assets, they're going to be valuing non-publicly traded assets. So if you own a small ranch or a business or who knows, a vineyard in Australia or whatever it is, you're going to have to, and then you're going to have to tax it on some potential,
But didn't they just say it's on your superannuation, which I'm assuming if it's in your RSP?
But how do you know what the unrealized means? You have to come up with a value, right? You bought a business for $100,000. Now it's worth $1 million. Well, who says it's worth $1 million? Some bureaucrat
so Steve,
in Adelaide.
There's private equity and private credit inside.
No, I know that, but I'm just saying.
What I'm saying, there's no market mechanism to tell the government that it's worth a thing. It's only worth that thing if someone's willing to pay for it.
But can you see the irony here, though? Because now,
what I was saying is there's certain things that you can hold. Like for example, in your RSP here in Canada, you can't hold. To my knowledge, you can't hold private. There's only certain things that you can hold in your RSP.
Yeah, but correct. But don't use the Canadian RSP.
You can't hold private security in your RSP.
Correct, but there are fund structures that are RSP eligible. Yes, I would imagine.
Yes. Yeah, they have to be RSP eligible. So okay. Anyways, that was the point I was making, Rich.
Fair. Rich's point is better than yours, Steve. So he just got up. But the irony with this is that, in the private equity, private credit world, you don't really know what that stuff is worth. They come up with a number, and I would imagine, maybe I'm wrong, but it's probably higher than what the actual sale price is if they're trying to liquidate it. Now, all of a sudden, you can see the situation where, oh man, we have to mark this, and now you have an incentive to mark it as low as possible because you don't want to incur the tax. So all of a sudden, you can get 20, 30, 40% markdowns in Australia on their private investments because they don't want to pay the tax man who's coming. It's not a
just
clean world, guys. It's just not
it's just a stupid idea. It's just like it's another UBI, it's another ESG. It's these things that sound great, proposed by people who can barely tie their shoes and don't live in the real world. And it has all these knock-on effects that don't address the underlying issue, which is there's not enough productivity growth. These governments need to spend less money and they need to extract more output from their inputs. I mean,
so here are my notes, my game notes for today.
Okay.
US downgrade, check. Australia, check. Canadian inflation, check. Elbows up, check. We did them all today, guys.
No, we didn't talk about housing affordability.
Yeah, boring.
Okay.
Next
We'll talk
week,
about it next time.
Steve wins another point. So the final score today is Steve 6, Rich 1,
Oh,
and Boomer's not
Boomer
really at
owes
the
$100
office.
bucks. No
I
pod,
owe-
no mic.
that's right.
All right, well, it's a good place to wrap it up. As always, guys, we appreciate the support. If you've enjoyed this episode, at least share it with one friend or family member and help us continue to build the Loonie Hour community. And as always, we'll see you next week.